Thank you very much for coming. And for those who are new to SF and haven't seen us before, welcome. And thank you so much for joining. So before we kick off tonight, I just want to acknowledge the Awabakal and Gadigal people, traditional custodians of the land on which we meet today, and pay my respects to their elders, past, present, and emerging. I also extend that respect to Aboriginal and Torres Strait Islander peoples here today. So everyone, our aim tonight really is to give you a really good overview of what's happening in the world, what the hell is going on right now, and more importantly, give you some tools on how to actually deal with that. And so with 25 years experience between Randy and I, we're going to be sharing a heap tonight, really based on what we're seeing on the ground. We'll come at it from the different sides, financial planning and broking. So what's happening in this world. So let me introduce you to Randy. Hey, Randy.
Hey, James, and welcome everyone. Great to see some familiar names here tonight. So looking forward to going through this presentation with you all tonight.
Awesome, mate. So good to be doing this. And Randy, for everyone who doesn't know, Randy heads up our mortgage broking side of the business. So Randy's been a mortgage broker for many, many years, and I'm the financial planning side. So we both run different teams, and together that is the Sufficient Funds crew now of about 26 people, and a bunch of whom are joining us tonight and can help out in the chat with questions as well as we go. So really a couple of things, what we want from you all tonight, and this can be challenging, especially if you've got little ones or pets or whatever it might be going on in the background, but put away any distractions if you can. Ask any questions you might have in the chat. Let's get that being super interactive, but also feel free to use the Q&A if you do want to keep things anonymous. Just note that if you'd like things kept privately there, but please, lots of questions. Importantly, this is the time you've dedicated to learning. So, make the most of it. Really, the reason we thought this session was really important, there's a few things. I mean, there's no doubt there's a lot of stress around all of this at the moment. There's lots of talk in the media around it, but because of that media hype, we want to make sure that you guys get the correct info out of it. And also, I guess, know what you need to do, if anything. And if you don't, well, happy days. So just note, we will spend quite a bit of time, or a little bit of time, I guess, painting the picture of what's happening at the moment. And I guess really what helps there is knowledge. Knowledge brings confidence, and confidence to act, which is really important. So we'll dive then into some of the action, really importantly, that you can take. We're not going to try not to put you to death with a whole heap of slides, although we are the money nerds. So we might, Randy, I think we might chuck a graph or two in there.
Yeah, one or two.
As we go. So we do only have an hour, so I'm going to shut up in a minute and hand it over so we can really get moving. What we're going to try and do is leave 15 minutes to the back end of this hour that we have to answer questions. And so keep the chat pumping, get that moving. And yes, like I said, it is interactive. So let's kind of warm that up a little bit. It'd be really, really great to hear from everyone. Let us know in the chat, what is your main priority for joining us today? What are you really hoping that you get out of tonight's session? So don't be afraid, dive in there, and let's get it going. So if anyone has any questions or anything, feel free to drop them in as well. But what are you hoping to get out of the session tonight? And while you're all adding your comments in there, let's get one quick.
Just to mention, James, it looks like the chat is disabled, so maybe just chuck in your questions in the Q&A section.
Might be able to enable the chat
while we fix up the chat. So I think
maybe see if you can play with that, Randy. I'm not sure. Probably going to mean me. So we'll keep rolling and we'll see if we can get that fixed. So on the this is a little bit boring, but it is important. We do need to note this is general advice only. So what we're talking about tonight is general in nature. The materials is general. We're not giving you personal advice here. And if you do need personal advice, obviously reach out to speak to us or speak to your professional that you're already using. So Q&A, the Q&A is definitely working.
The Q&A is coming through, so a few names coming for questions there. So definitely just anyone else, definitely add some more to make sure we can cover off what we need to for everyone.
Attendees can chat with everyone. I think I've just fixed it, guys. Double check for us. There we go. Happy days.
Perfect.
Hello. All right. So start to drop those comments in now. And I'm gonna keep rolling, but maybe Randy, you can start calling those out as we go. So look, for anyone who's not super familiar with us, Sufficient Funds, we have two sides of the business we talked about, the financial planning side and the home loans or the mortgage broking side. This is our vision. So we help driven millennials move beyond sufficient funds so they can smash their goals and make their dreams a reality. We'll send links in the email, and that's going to be sent out to everyone who attended. If you guys want to chat with us after this about anything, chat with some of our teams, some of our amazing advisors or mortgage brokers, you can certainly do so. But let's keep it rolling. So Randy, do you want to give us a bit of a feel for where we're at the moment?
Definitely, and it's probably one that everyone's been keeping an eye on. Obviously, inflation, cost of living is a key one, which has been on the upward trend over the last 12 months. However, in the most recent results on inflation, it has been noted a bit more of a cooling, which in turn, in the most recent RBA decision or meeting in July obviously start this month, they decided to put a hold. So hopefully the inflation cost of living is at the top end of what we've seen in the last 12 months, which was on the upward trajectory. However, the inflation results are still a concern for obviously Australia and the RBA. So it is at high levels. So definitely that is something that we need to be making note of and keeping an eye on. The latest rate decision, I guess, is one that hopefully will continue as a whole next month. Moving on to maybe a little bit of a graph. The first one for us for the night is the inflation rate. So as I mentioned, the trajectory of it since the last 3 years has been obviously the up with a bit of a cooling in the most recent results.
Yeah, so we promised a few graphs and here we go. So I mean, look, one thing I always find is really interesting is you have a look at kind of back here, and this is that time when inflation was at all-time lows in Australia, and that's off the back of COVID, right? No one's going to forget that anytime soon. We're all locked down and we couldn't spend money, we couldn't fly, we couldn't do anything fun. Even if we tried, there wasn't a lot happening in terms of the spending department, and that's what's going on here. And so it's interesting to kind of see on the other side what happens with rates at the same sort of time. So the same kind of 3-year period. And if you have a look at some of this, I guess, you know, what we're seeing is that interaction between inflation and rates. And so low inflation or low rates, sorry, if we look at this, low rates drive spending, right? And then spending, and these low rates stay low for a while, spending, all of a sudden, boom, inflation starts to rise. And then as inflation rises, the RBA freaks out, and that's what we've seen more recently. So
yes.
Yeah.
That kind of definitely leads on to, I guess, our next graph in regards to the cash rate. So the cash rate currently is at the 4.10. It has increased by 4% since May 2022, where it was sitting at 0.10, which is obviously record low for Australia. And look, right now the 4.10 is not the highest we've seen in the cash rate for the last 30 years. So if we look back 30 years back to 1990, when most of our parents were paying just under 18% in interest on the interest rates, which is crazy.
Complaining. My parents.
And then back in 2000, yeah, definitely 2000, we were at sitting at 6.25. 2008, 7.25, and then 2011, I guess 4.75, and that's kind of when we started seeing it drop from there to the last couple of years.
Yeah, I think the interesting thing here is, like, despite the craziness of what we've seen recently, we're actually still like the 4-ish rate that, with the cash rate at the moment is pretty close to the long-term averages. And
Correct.
So I guess, what comes of this is, whilst that's not a lot of, that doesn't provide a lot of respite for those who have bought, especially kind of, and this might be a lot of you guys who are on tonight, but the ones listing and bought kind of at the bottom there. And, we've already seen the mention about, like, Louisa, you're not alone in terms of the fixed rate cliff and the fixed rates, and everyone's coming off fixed rates. We came off a fixed rate in the last couple of months as well. And all of a sudden, you're back up to here. We'll touch on that in a little bit, but really, I guess, for where everyone's at the moment, long-term is fine. And it's fine for all of our parents to complain about what they went through, but it's about perspective. Sometimes it helps to zoom out, but it doesn't always change exactly where we are right now. And for a lot of people, this was unforeseen. And, for all of us, no one could predict that crazy rate rise, which has been driven by all sorts of other things as well. So, yeah, Randy, do you want to touch quickly on the property side of things?
Yeah, definitely. So quick note on property rentals. So property prices, obviously every city and town are different for all sorts of reasons. They've got their own markets, but generally house prices are still trending up all over Australia. However, some more, I guess, from my point of view, recent bank valuations that we've actually completed for some clients have started coming short on existing properties. And this is probably off the valuer's opinion on the market, potentially changing to be more conservative. And it's also potentially off the back of what they're seeing as stress sales of clients who've probably held off, as long as possible, but now they're at the tipping point of, hey, I need to sell. So that's coming through now from what we're starting to see. And just to mention that, I guess the price points of those VAL shortfalls was around that 1.5 mil range. So they're probably a little bit more higher end of properties. On the rental market, so looking at, I guess, CoreLogic's recent quarterly rental review showed 2.5 increase in the June quarter. So not only are homeowners feeling the pinch at the moment with interest rates, it's also obviously the renters as well, seeing their cost of living, their rental expense as well, increasing as well. So I think everyone's in a similar place at the moment.
Everyone's kind of feeling the squeeze a little bit, and there's probably no escaping that at the moment in terms of where you sit in the market. And so although for some of the parents who may have paid off their loans, but I don't think there's many of those listening today. So let's touch quickly on the implications, Randy, and the borrower, or let's get to that in a sec. But tell us what you think about the predictions around some of the rates, and what are you hearing from the big banks, especially?
Yeah, so looking at the major banks and some of their predictions, looking at what their predictions are at this week. At the moment, if you look at NAB and Westpac, they're both predicting 2 more rate rises in August and September for the rest of the year. CBA is predicting 1 more rate rise in August, and then a pause. And obviously ANZ, actually, they changed their prediction, I think, a couple of days ago, and they've actually changed it to a sit back and hold for the rest of, I guess, for this year. So they're no longer predicting any more rate rises, which is, look, in summary, it's a mixed forecast by some of these lenders and economists. Guess, look, some are predicting a hold and C approach, but in the coming months, I guess we're going to see what happens early next month as well. But it's, with some of these lenders, they are predicting 1 or 2 more rate rises this year.
And fingers crossed, ANZ's right.
Correct.
So, and Randy, what about some of the implications for borrowers and what they can do about it?
Yeah, definitely. So, look, the implications of these, I guess, increasing interest rates, especially for someone trying to get into the market and look at more lending, it's your borrowing capacity that's affected. And the borrowing capacity, how it's affected, is one where maybe I'll explain what a bank does when they're looking at a new loan. One of the things when they're looking at your borrowing capacity, they use what's called an assessment rate. So this assessment rate, traditionally, it's a 3% buffer on the standard interest rate on a bank. So that 3% buffer, it creates obviously a protection for the bank and for the customer to, in case interest rates go up for future rate rises, that the applicant can still afford the loan repayments that they're looking to take out. So with that 3% buffer, it protects obviously, the bank and the customer. Interesting point as well, the bank's buffer has been superseded, I guess. If you look at 12 months ago, the bank's assessment rate was at 5.5%, was their assessment rate, where right now we've gone past that assessment rate for a lot of clients that took out those loans 12 or 2 years ago, which is quite interesting.
Isn't that crazy? So you were assessed 2 years ago at 5.5 and the bank thought, there's so much buffer in this.
Yeah.
And now we're at a position where even the rates at the moment are higher than what that was. And we're talking a year later.
Correct. So it's a little bit concerning for those clients that have gone past that. So definitely something to keep an eye on.
Wasn't it? Aren't they so there's the living cost that the banks use as well in their calculators. Is that right? So there's assessment of new loans, which kind of takes and refinances as well.
Yep, correct. So the living cost as well is one that the banks have recently, obviously in line with what's happening in the environment at the moment in Australia, the living costs have been adjusted on their calculations. So, what you may have been pre-approved maybe 6 months ago, 12 months ago, at what the cost of living was at that time has changed now. So potentially your borrowing capacity has obviously reduced. If you were looking at this 12 months ago, it has reduced to do with your assessment rate and also with the living expense the banks have as a minimum that they apply to your situation. Yeah. And as well as that, I guess if you're looking to not just borrow for a new purchase, if you're looking to refinance, definitely your ability is getting affected. So even if you're an existing customer of a bank, what you could afford 2 years ago, it significantly would have changed over the last 2 years. Even if your earnings hasn't changed, some of these lenders, with these situations that clients can't refinance as well. Look, I mentioned that some of these lenders are implementing lower assessment rates in these situations. Not all lenders. Maybe there's just 2 or 3 at the moment are passing these new policies where instead of using that traditional 3% buffer for these clients that actually want to refinance, they're implementing like a 1% buffer to help these clients that are looking for a dollar for dollar refinances. So those are for clients that don't pass on the 3%. These lenders are offering this alternative servicing with a 1% servicing. But definitely don't assume your lender can offer this. Definitely talk to your broker to check what options you have if you are in a situation of looking to refinance and obviously take out new lending as well.
100%. And so let's talk about this little thing here called the fixed rate cliff. We've all heard this in the media. And so, Randy, do you want to give us a bit more of a feel for what the hell this actually is?
Yes. So as you mentioned earlier as well, like it's one where clients took out fixed rates, 1 to 3 years ago at the record low rates that we were seeing. So we were seeing, probably lowest, maybe 1.8 to 2% was what we were seeing as the lowest fixed rates out there. And these fixed rate periods when they're rolling out of those fixed periods, in the next 6 months, 1 year, maybe 2 years, they'll be rolling into 6 to 7% interest rates on their owner occupied and on investment loans as well, which is quite concerning. On the average loan size, I guess in Australia is about 600k. This could mean about an extra 2,000 per month on top of what you would be paying at your 1.8 or 2%, would be $2,000 per month extra that you would have to find to be paid towards your mortgage. So 24,000 per annum, and that's just on the interest rate alone. So it's a concern that you need to be mindful of. So what can you do if you are in this situation? Obviously, there's things you just need to be mindful of. So don't just accept the rollover rate that the bank is going to roll you over to. So when your fixed rate expires, automatically your loan will just roll over to the bank's standard variable rate. So that may not be the bank's best discounted rate. So definitely, chatting to your broker to understand, hey, what is that rate? And what are my repayments going to be as well? So definitely getting ahead of that rollover, 2 or 3 months ahead of the expiry. You definitely want to be reaching out to your broker to, start looking at what your options are with your current lender. Start looking at, what can my broker, can you get me a further discount off the standard rollover rate that my loan will roll over to? So look at your current lender.
I was just thinking about because Randy, for everyone listening, is of course he's my broker, and we had our fixed rate coming up. We had a split. We're about 70% fixed for a couple of years. We're at like 1.8%, which is amazing. That fixed rate was coming up, and the bank obviously comes out and we're going to put you on 6.5, and obviously you don't accept that, like Randy's saying. And I think, Randy, what happened with us is we pushed back on that. They went to a different rate prior. Actually, no, we'd been trying to negotiate the variable part, hadn't we? And they dropped the variable part a little bit, but it was still pretty rubbish. And I think when you're stuck in a fixed rate, your variable portion doesn't look so risky to the bank.
Yeah, correct. So it's one where the bank does now they're a lot more aware of what's happening. So they are looking at, hey, what this customer, how likely are they going to, actually change banks? If they can see you've got a fixed rate for another year, and they're trying to price the variable portion, they know that you're not going to move, so they won't give you the best pricing on that variable portion, which is what happened. I think
we've had a couple of clients with that example recently, but yeah, like you said, when the fixed rate's coming up, if you get ahead of it, you can get stuck in, and that's where you can really negotiate and threaten to leave and see what happens. Yeah.
Well, definitely, and it's one, like I mentioned, talk to your broker, look at what your current lender can offer, but then get them to compare, look what else is out there in the market. So once your fixed rate does expire, you roll over to that variable rate, you've got more options with your loan, because once you're on the variable rate product, you can, look to change lenders without any restrictions or penalties. There are some small fees involved, but it does give you the options to, go from a 6.5% interest rate, maybe another lender's offering 6%. So definitely savings there to be made if you just shop around a bit. And that's definitely to have you can use a broker, definitely, to do that running around for you, to do those comparisons as well. And to mention, if you have less than 12 months, another option to look at here, if you're in this situation, if you have less than 12 months to go, calculating your expected repayments now, and actually start acting like it's already changed. For example, putting in, if it's $2,000 more that you're going to be paying, putting that $2,000 more into your offset account, if you've got an offset account, or into your savings account, or onto the variable portion that you've got. If you've got a split portion, putting that extra $2,000 into that loan, just to get into a habit. Put your higher repayments, that you're going to start paying in 12 months time, 6 months time already, into that, putting it aside. It's going to help. So when the rollover takes place,
Yeah.
Again?
Yeah, I was just going to say, take some of that shock off. Like the idea of a cliff is you're falling off, right? But if you get some, really just give yourself some time to warm up to that and force that a little bit, you become used to it. And, it's not possible for everyone, but it's worth trying, because often we find, from that budgeting perspective is, and we hear this all the time, right? Save first, spend later. If you force the savings before it lands in the bank account, you automate that out into the mortgage or wherever that might be going. And in this case, we're talking the mortgage, obviously, then that works for you. But like you said, Randy, you could be putting that into a bank account, have that building up. Maybe it's the offset, maybe it's something else, but you've got that building up. So there's a buffer that you're creating naturally, but you've also got that behavior of forcing yourself to feel a little bit tighter, because that's what's coming and you might as well be prepared for it, so to speak. So in terms of the budget, that's another thing. Look, really, that it is a dirty word, that dirty B word, but if you can forecast your own spending and the effect that that's going to have with those increased repayments, then you can really get ahead. And so a budget is something that I know when I keep one, and I don't enjoy it, but when I keep one, I automatically have more money, because what's happening there is I'm conscious of what's coming and going. And so, a budget is something that we'll send out to everyone. We've got a download or an email that'll go out to every attendee after this, and we'll do that. I think it's going out tomorrow, but that'll have a whole bunch of stuff that'll kind of fill any gaps from tonight, but also give you some downloads and some things you can do, and that'll include the budget if that's going to be helpful for anyone as well.
Before we jump on to the next one, there's one of those questions that's come through around how often, I guess, you can start asking discounts on your variable portion if you are on a fixed rate. Look, I'd say it doesn't hurt to ask let's say every 3 months, every month potentially. You can still be asking the lender, is there any room to move on your discount? Because it's every month the banks are setting their own discount they want to apply to their book or to their clients. So definitely, it doesn't hurt to ask the question. They could just say no. That's the worst thing they can do, or they can get you that extra discount onto that variable portion. So definitely no limit, I'd say. Definitely I'd be doing, if you want to get as much saving every month, wouldn't hurt to do.
Yeah, 100%. And if Randy's your broker, he loves a good monthly prompt to chase them up. So yeah, good to have you guys on, Laura and Joe, and everyone else who's on. Thank you for joining us. Now, if you have any more questions, please keep them coming. You've got an incredibly smart mortgage broker at your disposal here, so make the most of it. Let's talk a bit about the stress and some of the things we can do there, Randy. What are some proactive options here?
Definitely. So if we're looking at the mortgage, what options do you have from a lending or feature point of view? So an offset account or redraw feature is one which pretty much every bank or every loan has the option of having. So with an offset account, it is one where if you do have an offset account, it's a separate account to your actual loan, where the offset account, if you have, let's say, 50,000 in that offset account, let's say your loan's 500,000, that 50,000 that you've got in your offset account is offsetting what the bank charges you interest on. So instead of charging you interest on 500,000, they charge you interest on 450,000. Your balance is still 500,000, but because you had 50,000 sitting in that offset account, the lender, I guess, sees that, and so they only charge you interest on that 450. So that is one feature that definitely can work for you. The other one, redraw, does work similar to an offset account, but the redraw actually sits within the loan itself. So with redraw, it's when you make extra repayments above your minimum repayment. So, if your minimum repayment is, let's say 2,000, and you pay an extra 500 on top of that to the loan, that extra 500 sits in redraw, and then you can just redraw that back out from that loan as the name implies. So we see a lot of new clients coming through who have these features, but they're not actually using them correctly. So these are features that the banks offer definitely to help, I guess, with minimizing your interest expense, and also assist with reducing your loan repayments at times as well. So definitely something, again, comes with every loan, every bank offers it. So definitely, something to keep in mind. If you have one, you're not utilizing it, definitely start looking at it.
So Randy, there's a question there in the chat. Can you have an offset account when your loan is on a variable rate? And maybe at the same time, can you also have one with a fixed rate?
So, good question. So traditionally, the offset account is linked to a variable rate home loan. And I'll say traditionally because there's probably one or two lenders only out there that do actually offer a fixed rate with an offset account linked to it. So there's only one or two lenders that actually offer that feature on a fixed rate. But traditionally, it's a variable rate product is where the offset account would be attached to. Yeah.
Awesome. And there's a question in the Q&A there. Does it make any difference if my offset account is my main account that I'm getting paid into, but also paying bills out of? Is it better to have that with just additional money sitting in it without constant withdrawals? I could probably talk to that a little bit. So, and great question, because look, it doesn't, at face value, the more money you have in an offset account, the better. However, behavior is a really different thing, right? There's a difference between behavior and your saving or the returns that you might get out of that. And so often we find, and we do a lot of work with clients in the financial planning side of things and what we call a spending plan. So when you get paid, where does it go? And how do you structure accounts so that you know what money's in there? And what we often see is we get people who have a big offset account and they stuff all their cash in there and they get paid in there. And everything comes in and out of there. They might have a credit card as well, so that can confuse things a little bit too. But if everything's in there and you're trying to plan your holiday, you're not sure exactly how much is the emergency fund, how much is for the holiday, what have you got for all the other bits and pieces, that actually makes it very difficult. And I'm not exactly answering your question, but I think I'm going to get off my soapbox in a second. But that part makes it really difficult to get on top of your day-to-day spending. The only way to really get on top of your day-to-day is to be fully conscious of what's coming and going. And that's where a couple of splits can work. And one of the things we do with clients is at its basic level, just split the fun from the boring. Think about, all the stuff you don't care about, it's automatic, it's there, the Woolies, the Coles, the mortgage, but split out the fun so you're actually on top of it. Anything else to add on that one, Randy?
Yeah, well, what you're kind of saying, obviously, you can't split it, where there are actually lenders that actually offer that multiple offset account option. So even if you have your savings, your different buckets, and you have your everyday transaction account where your money comes in and your expenses go out, and then you just change your savings to the different buckets, every single dollar you have is working for you to reduce your interest expense, in those scenarios. But if you have just the one offset account, which they are fully transactional offset accounts, so you can manage your incomes and expenses in the one account, it does help with minimizing the interest, and it's calculated daily, the interest for every dollar that's in that offset account as well.
Awesome. And mate, there was another question in there that was, is there a better time to threaten to leave the bank? So are there retention targets, that type of thing?
Yeah, look, I'm not 100% sure on that one. Like, it's one, I guess, that's at the moment, what's happening with the RBA when they meet, it is monthly at the moment. So off the back of that, RBA meeting, what happens from that meeting, then the lenders then change their, from a week or two after that, the lenders then announce their changes to their rates. So look, I wouldn't be able to say specifically if they've got targets or not, but it's definitely one at the moment. The retention teams on all the lenders, they're actually making a big emphasis to keep clients in-house or keeping with the current lenders, because what's happening, everyone started shopping around in the last 6 months with the rates, or 12 months with rates going up and up. So the banks are being a lot more conscious of clients leaving. So they are, when they actually think you're going to leave, and you're actually a real retention risk, sometimes they do offer further discounts that may be like, oh, we're just going to offer you 5% further discount, 0.5% discount. But then when you actually send a discharge form to them, they're like, hang on, we're going to now offer you 1% off. So sometimes the banks are conscious, and that sometimes you do bluff that you are going to leave. But sending an actual discharge sometimes as a bluff as well does help at times. But look, definitely talk to your broker about that. That can definitely help with that a little bit further.
And maybe a good thing just to go back to is also thinking about the offset account. That's kind of where you park your savings. And obviously that reduces the interest you're paying, where redraw is the additional funds you've paid towards that loan or the minimum repayments. Now you can use redraw like an offset, right? In that way, is you can dump it all in and you can pull it out. I know, was it at the start of COVID when one of the lenders cancelled everyone's redraws and they said that was allowable in the contract? I think they backtracked on that in the end though.
Yeah, I think they had to give it all back from memory. But definitely, look, obviously speaking about redraw, maybe an example of how you could also help with what the redraw feature and minimizing your repayments. So we did have a similar, a recent client that was in a situation where they had a lot of savings, outside of their loan, where they had no plans for that savings. So what they did to minimize their repayments on their loan, to actually reduce the minimum repayment, they dumped, let's say a lump sum of their savings into the actual loan, into redraw. So when you do that, to reduce your minimum repayment, you can actually call the lender to say, hey, I've just dumped a whole bunch of money into my loan. My actual balance was reduced, but there's redraw there of 50,000. The bank doesn't automatically adjust your minimum repayment to the new balance. So what these clients did, they called up and said, hey, I want you to actually reduce my limit and actually remove the redraw and readjust my minimum repayment to the lower balance of the loan. So the actual minimum repayment reduced by them putting in that extra funds into the loan, but then obviously you've paid back what you owe the bank, and that obviously disappears. So then you can't redraw it back out, but the minimum repayment was reduced on that client's loan in that example.
Yeah. And I think we had another example recently of one of my clients where they'd borrowed more than they needed, and there was it was a couple of $100,000. They borrowed more than they needed because they were thinking maybe some renos. They decided not to do all of that. And yeah, same kind of scenario, dump it in, cut the limit right there, reduce your balance. And like you said, you've got to get the bank to make those changes.
And it reduces your minimum repayment straight away. So it's one way, if you wanted to see where you can tweak your monthly repayments, that's one way to look at it. So yeah, definitely.
What about interest only, Randy?
So that's one thing I was going to jump into. So interest only, look, this is probably more relevant to investors. Like at the moment with the banks, if you've got an owner-occupied loan, they don't really like it when it's on interest only. They actually want to see that you're actually paying it down. So on interest only, if you are an investor, if you've got an investment loan, you just need to be mindful. If you do want to switch it to interest only, the interest rates are slightly higher, let's say 0.2, 0.3 higher than your principal and interest repayment loans. But the main saving there is your repayment is no longer going to be principal and interest. It's just going to be the interest. So your actual monthly repayment does reduce if you switch it to interest only. So for example, a 600K loan, a 6% interest rate, there's about a saving of about $450 per month by switching it to interest only and paying a slightly higher interest rate on that kind of example. So there is some saving per month you could be earning, achieving if you have an investment loan and you're trying to find what you can tweak to get that extra saving per month.
Yeah, 100%. And so Randy, we just had another question in. So if you're working to buy another property in the near future, how might this influence how and when you review that current lender scenario? Yeah,
definitely. Well, look, it's one way you could be reviewing it now, but definitely, just before you submit the application for the further lending or for the next purchase, you want to potentially price that existing loan to make sure your rate goes down, because that's going to affect your new borrowing capacity as well. Because instead of them using 6%, if you can get a pricing off them to reduce to the 5% interest rate, that helps if your borrowing capacity for the new lending and the new purchase.
Yeah, and that probably helps answer. That was Russell's question, and Felicity's dropped one in there as well around getting some relief if you've already had it. How long do you have to wait? And I think similar scenario, right? You don't really have to wait very long. You could be hitting them up every month. And I mean, look, I don't know, I've never tried it myself, but maybe being the squeaky wheel helps.
Yeah. Well, look, I'll mention, look, pretty much, like I said, you can review it month to month, but there are some lenders out there that they actually put hey, every 6 months is our window of reviewing it. So I won't name the lender, but it's one that some lenders won't allow you to do it month to month. Some lenders actually say, we've already priced this client 6 months ago. We can't review it until after 6 months' time. So I do mention there are lenders out there that's a little bit more. You need to wait a little bit more period of time. Yeah.
Awesome. And so, I mean, we talked about the budget a little bit before, but outside of your mortgage with the budget, there are other opportunities, right? The mortgage isn't your only cost. And so if you're under this kind of pressure at the moment, have a think about what some of the biggest costs are in your budget. And often we see those as things like groceries. The grocery shopping, if you can structure your shopping, as painful as it can be when you're busy, if you do the fortnightly or the weekly shop, whether it's online or not, I mean, we do it online, so we don't have to go in and buy all the other things that we don't need. But again, you risk then getting the dodgy apples and the dodgy whatever coming, and you get no choice, right? But having some structure around that and not being in there. Actually, I dropped a TikTok video in the other day, and I was talking about a client who I was just been chatting to, and she's earning really good money. She was on about 210,000, but super busy, super stressed, and always just like finishes a meeting, and it's either, if it's not Uber Eats at 6, 7 or 8 o'clock at night, it's racing out to the shops to grab that one thing that then turns into 8 or 9. So there's options there. Think about insurance. Now, insurance is one of those things that is like a mortgage, fairly easy to shop around, especially the general insurance side of things, like the car and the home and the health, all of that type of thing. There are options for shopping around depending on your scenario. But another thing to think about with insurance is the excess that you set. Now, this is really, be careful. This is not personal advice, but when you think about an excess, you are essentially saying, I'm self-insuring that part. And so it might be the first $1,000 on your car insurance. But if you change that 1,000 up to 2,000 or 3,000, and where you would do that is if you have an emergency fund in place. An emergency fund sits there as a bucket that is there for that exact reason. And I guess the idea there is you're betting on not needing to claim. And so if you don't claim, you win. And statistically, you won't have to. Now, if you have to claim, unfortunately, then you cop the extra. But when you do that, you've got less premiums through the year, and you've got your emergency fund in the rare chance that you actually have to use it. Forgotten subscriptions is another one. I stumbled across a KO subscription that I put in place about a year ago. I think I was to watch this State of Origin, and I'd been paying $30 a month since then, and we watch sport like fairly rarely. So things like that are another thing that you can have a look at, and super good to do a bit of a review of the bank statements every couple of months, every quarter, just to see what's going through. So what about some pitfalls, Randy? And then we'll get into some questions from everyone if there are any others.
Yep, definitely. So look, with your mortgage, I guess with your lender, missing payments on your mortgage, automate your repayments so you never miss a payment. Everything now with all the lenders is a lot more transparent. It's noted, 1 or 2 days late. It's all transparent these days on your credit file. So definitely, if you're looking for further lending, or do anything with your mortgage, making sure your repayments, there's no issues. Set up your automatic repayments, so you don't have to do it manually. Don't miss it. That's one key one to take note of. And even if you've got savings accounts as well, it's one where the banks, or even now your credit file, it picks up if your savings accounts in default or in debit, for more than let's say a couple of days, it's all getting picked up. So especially when the banks are looking, hey, I need your savings accounts, your transaction accounts, they're looking at those, hey, why are they going into negative in these situations? And those questions are ones that we're getting a lot more these days. So the banks are going through everything in a lot more detail. So definitely take note. If you are, having a debit in your savings, let's see what you can do to kind of make sure it stays in credit. Delay some direct debits if you need to, but definitely something that you need to be mindful of, that the banks are looking at. The other one is accountants. So if you're self-employed and you're looking and not declaring your full income, this will affect borrowing capacity if you're looking to obtain further lending. So if you're obviously your accountant is trying to minimize your tax, obviously there's a reason for that. But then if you're actually looking to get more lending, that's going to affect what you can potentially borrow. So if a loan in the near future, be aware of the accountant that's solely focused on tax minimization. The other one I've got is neglecting to regularly review your loans. So you'd be surprised how many customers I've got. We try to reach out to them, but 2 or 3 years ago, they still haven't tried to contact us back. Hey, let's look at our home loan. They were paying massive interest rates, but they still haven't reviewed. They're not reviewing it. We do try to contact our clients, to see, hey, let's have a look at your interest rate. Let's review it. So definitely try avoid that loyalty tax with the lender, because the lender's not going to contact you to say, hey, you're paying too much interest to us. They're not going to tell you that. So unless you make the question, you contact your broker, then that's where you're going to get savings. So definitely don't be afraid to ask the question. The worst thing, like I mentioned before, the worst thing they can say is no, but at least you've tried. And look, every bank's situation and policy is a little bit different. So definitely be mindful of, if you're looking at further lending, shop around. It's not one lender fits. It's not the same for every situation. So definitely looking at your options, different policies that the banks offer is out there. So
100%. And so keep the questions coming, guys, if you've got anything else, and we'll dive into those in a second. Just to kind of wrap all of this up, it's a really good idea to have protection in place. And really that's for 2 parts. That's for you personally and for your property. So obviously with the property side of things, it's making sure you've got that all sorted, making sure, actually we know someone who had a fire at their place. And this is a really interesting point, and something that's super important to think about is with building insurance, the way building prices have gone through the roof in the last 3 years or so. What you'll probably find is if you've put building insurance in place in the last maybe 5 years, you'll find that the cost that you might need to actually replace it is way, way higher than what the cover is that you actually have. And we've seen a couple of people, one person actually with a fire at their place who has now kind of paid the price for that. Now, they were lucky they're in a pretty good spot financially, but again, it's never something you ever want to have to deal with. Now, when it comes to your own insurance and insuring you, what we mean there is, this is where I put my financial planning hat right on, and we think about those kind of ideas of when you're earning income and you rely on that income, then it's a really good idea to make sure that if you can't work because you're sick or you're injured, then you've got something there that's in place to look after you. Now, sick and injured is one thing, but way worse, of course, is another. And so, unfortunately, and I've been dealing with this today with a client, we're working through a terminal illness claim at the moment. We've got a couple of trauma claims on the go in the business as well. And now, part of that is we're incredibly privileged to be able to help in those scenarios. But on the flip side, someone's unfortunately going through some really tough times. And one, that's health, and it's dealing with the family and figuring out, what life's going to look like potentially afterwards, but secondly, financially. And so really, more importantly than anything, it's income protection. It's the most commonly claimed upon cover. It's also the most expensive. And so it's really important to get good advice around that. And how do you kind of fix that, put that in place? Income protection pays you monthly if you're unable to work because you're sick or injured. There's also life insurance, which is, as the name suggests, it could be death cover as well. It's called, if you pass away, that's a lump sum. Now, the first thing you're covering with life insurance is your mortgage, and you want that cleared and paid out no matter what. TPD, total permanent disability, is another one. So if you're unable to ever work again or unlikely to ever return to work, then something really, really serious, super rare has happened, but that's another lump sum to kind of kick in and help you just get through. It might be paying out the mortgage. It might be having someone to look after you. If you're unable to work, you might not be able to look after yourself. Those types of things are really important considerations there. And then trauma cover is more specific illnesses. That's the kind of one that, you know, it's probably a little bit more of a luxury. It's a lesser known because a lot of people have this stuff by default in their super funds. But if that is you and it's just sitting in your super fund, it is worth having a look at that and making sure, for one, is it enough? And two, is it the quality that you need to be able to do what it does? You're paying money for this stuff. You've got to make sure that it's actually worthwhile and it's actually working for you. So if you have an advisor, speak to them. That is definitely an area which can be quite a minefield. You know, if you're struggling for, you know, the mortgage stress is really kicking in, then paying for a chunk of that through super is possible. But speak to someone, a professional, to make sure that that is the right way to go for you. So guys, that brings us to the end. We've got about 7 minutes and there might be a couple of extra questions in there. Actually, just on that insurance note, while I think of it, you can log into your portal and usually you'll be able to find those details fairly quickly if you haven't seen that already. So Tahir, great to have you on, mate. Are there any refinance options, Randy, if your LVR is over 100%?
At the moment, I haven't come across one that in London that will look at that situation. The fact being, you know, worst case scenario, you default on 100% of your loan, the bank has no recourse there. So at the moment, there's not many options for refinancing when your LVR is 100%. That said, look, there are 40, like for example, on our panel, we've got 40 different lenders. Out of those 40 different lenders, you know, you can do multiple valuations. One might come back higher than the other one. So definitely shopping around on your property value. You know, if it's this month, if it doesn't come back satisfactory, maybe 2 months time, the markets are changing at the moment. So you never know. You might get lucky with a good valuation. You can jump onto it. But at the moment, there's not many options there.
That's probably a good point to note that some people might end up, like if you have 2 properties, for example, one of them might be at 100%. So maybe you bought it in the last couple of years and it's dropped a little bit since then. But if you have a second property, you can combine the security of those and work out a way of actually using both in terms of the lending. If your LVR, your loan to value ratio, is lower on the other one. Is that right, Randy? So you can kind of combine those if you need to.
Correct. So you can utilize the other equity in the other property to have an overall LVR that the one that the bank will accept.
Yeah.
So,
awesome.
yeah.
And Russell's got another one, really good. So may lenders offer rates to existing customers that are below those they've advertised on their websites?
Well, look, at the moment, I'll say yes and no. Look, it's one where the banks, what they advertise is what they advertise. It's not always the lowest rate. So definitely asking the question, hey, I'm an existing customer. For retention, what can you offer me? Because in that scenario, what I would do as a broker, I would provide that lender, hey, well, the client's actually looking to leave. This is another lender that's offering a cheaper interest rate. Can you match it to keep it or beat it? So then that's when they will drop their interest rate potentially below the advertised rate that you may be on at the moment. So their answer, you can potentially ask for a further discount.
Yeah, awesome. And there's another question there. So any advice for people stuck in that current struggle of deciding whether to sell their property or hold on to it since those kind of crazy rate rises. And so, I mean, that's probably more, that's really relevant, I guess, for, you know, some of that stuff we talked about earlier around what might be happening in the market. What do you think?
Potentially. So it's maybe just recap on that question again. Sorry.
Yeah. So yeah. Any advice for people stuck in that current struggle of deciding whether to sell or hold on? So rates have risen since purchasing, at that point where it's a real stretch. Things are super tight. I mean, I guess, you know, number one, I'd be saying, well, can you handle one extra rate rise potentially? Is there room to handle one more? I think, you know, whilst the banks are never 100% correct, you know, what Randy's saying earlier from what we're seeing from the big banks is, you know, a couple of them are saying we might get 2 rises. One of them saying we're not getting any. And so I feel like it's probably that difference between, well, what does none, 1 and 2 look like at the moment? That's the information we have at hand, right?
Yeah, and that comes down to talking to your broker to assessing your situation with what are the repayments. If one more repayment, one more rate rise, what does my repayments look like? Look at 2, look at 3, and if that gets to a point where you're like, we're actually going backwards here, then that might help your decision in selling or keeping a property. In obviously in your own individual situation. So it's about looking at the information you can obtain and do some predictions, what the rates could do, and then assess that in your own situation from there.
So we've got another one in the Q&A. So
yeah, I saw that one as well.
Yeah, have you read that? So if you've got, I'll read it out for everyone. So if you've got a pre-approval today, which lasted 3 months and then rates went up again twice, if you were to purchase in month 3, would you expect the formal application and what you're approved for come back by March, or do they factor that in?
So this is definitely a great question, because what I'd suggest is talk to your broker to confirm if the lender that issued the pre-approval, if the pre-approval is, if some lenders will actually, what they got a pre-approved it on will actually hold on to that assessment rate or that interest rate at that point in time that they issued that pre-approval. They will, use that if you formalize it within that 3-month window. If your pre-approval expires, then they would reassess you on a new extension of that pre-approval at that point in time on that assessment rate. But maybe going back to the pre-approval, it depends on the lender if they will, use the same assessment rate if you come in 2 months later. But there are some lenders that, even though they've issued you a pre-approval 3 months ago, and then you formalize it at month 2, they'll reassess you at that assessment rate at that point in time. So it depends on the lender that you've got the pre-approval with. So definitely check with your broker or your bank that you've got it with on that one.